Hey everyone, this is Kirk here again at OptionAlpha.com. This video tutorial is for a neutral option strategy in the long straddle. So let's get right into it here. The market outlook for this strategy is just really looking for a big move in either direction. So if you're going to trade a long straddle, you really want a huge move. You just don't care which direction it's in. So this is really the ideal market neutral strategy. The stock can go up, it can go down. As long as it just moves and doesn't stay right where it is, then this is a great strategy for you. So again, this is specifically designed for high volatility conditions where stocks are swinging wildly back and forth. Now, how to set this up, again, is very easy. Think about it like purchasing two long options and just throwing those two options together. So all you're going to do is simply buy a call option and a put option with the same strike price for the same expiration period. So in our example, we're going to buy one at the money call at 40 strike, and we're going to buy one at the money call or at the money put at a 40 strike as well. So again, that same strike price, and that's where the option payoff diagram really pivots here, right at 40. So we're going to buy an option here and buy an option there. Now you can slide these purchases up or down, but most strategies are really centered around at the money options because we don't care which direction it goes as long as it moves. So there's no real point in sliding it up here to 50. Then you'd be more tilted towards the bear side. You could slide it down to 30, but again, you'd be more tilted towards the bear side on 30 and towards the bullish side on 50. So what's the risk here? Well, the maximum loss occurs if the underlying stock remains right where it is at expiration, so right at the strike prices. The maximum risk would occur if the stock closes and doesn't move anywhere. It just closes right at 40 in our example. In this case, we'd hit the lowest point on our payoff diagram here, and that would be our maximum loss. In this case, it would be $400. So if at expiration the stock's price is between the strikes, then both options expire worthless, so you lose the money that you outlaid to purchase the strategy. The profit potential for this strategy is of course unlimited. Really, the stock could go up as far as it wants. It could really go down as far as it wants, capped at zero, of course. But the net profit is the gross profit less the premium that you paid. So as always, if you have a strategy where you outlay about $400, which is your max loss, you have to at least make more than that in value of the options before expiration, before you can start to make money. But really, the profit potential for this strategy is virtually unlimited. So long as the stock moves and moves in a very violent fashion, then you actually are going to make a lot of money. With volatility, since we want a big move in either direction, an increase in implied volatility would have a very positive impact on this strategy. Now notice that I would use the word in this particular slide, increase in volatility. A decrease in volatility is going to not help our position. Again, we are trading a strategy where we want a volatile stock, so we want increasing volatility, more rapid and wild movement. Decreasing implied volatility or a stock that starts to trade kind of sideways or right at 40 is very bad for the strategy. So again, increasing volatility is really what we want, not decreasing volatility. Time decay is actually going to have a negative impact on this strategy as well because, again, remember that we're buying these options, so they have a finite life, and it needs to be a make it or break it type of a strategy where the options need to move quickly, or the stock needs to move quickly in the right direction, whether that's up or down, but that needs to happen fast. It can't slowly and progressively move towards that area by expiration, or we're going to start to see the effects of time decay really eat away at our profit. Now, because this consists of being long two options, every day that passes without a move in the stock's price actually has double the impact of time decay. So it's not like having one long call option or one long put option where we have just single time decay to worry about. Now we have time decay to worry about for both options. So it's kind of double the timetable that we're working with. It needs to happen much quicker. Break-even points on these long straddles are really easy to see. All you're going to do for the upper level, because there's two break-even points on this particular strategy, is you're going to take the long call strike and add the premium. So all you're going to do is take the long 40 strike and add the premium, and that creates your break-even on the upper level. On the lower level, you're going to take the long put price and subtract the premium that you got. So again, the lower level, we're going to take the put price or long strike of the put at 40 and subtract the premium, and that creates our break even on the bottom side. So there's 2 break-even points on this. So long as the stock is moving, like we've continued to say in this video, then you're going to make money if you get beyond those break-even points. Now let's look at an example real quick. If the stock price is trading at, say, 40, we are going to buy 140 call for $200 and buy 140 put for $200 as well. Now the net debit on the trader, the net outlay of money is $400 because we had to buy both of these options. The maximum loss we can incur is $400. Again, that's if the stock closes right at our strike prices. And you can see visually here on the chart, that's our max loss at $400. Now the maximum profit potential is unlimited because these arrows go up. As the stock price can go up as high as it wants to go. There's no range bound to the high side. The low side, it's only range bound to 0, in which case you'd still make a really good profit. So some tips and tricks that I've learned along the way when trading these particular strategies. On the outset, this looks like an easy winner, a home run even all the time, right? You're probably watching this video going, wow, Kirk, this is an easy strategy. Why don't more people do it? Well, you really want to use these during periods of low to high volatility versus adding during periods of already high volatility. So like I said, you want to enter this position when a stock is actually fairly calm and it is predicted to break out. You just don't know which direction it's going to break out. It's not a good idea to add this strategy if a stock is already making a lot of high volatility moves, because more than likely the premiums are going to be so high anyway that any decrease in volatility is going to have a negative impact on your portfolio. So look to close out the position early if you get a quick move and implied volatility without any underlying movement in the underlying stock. So like I said before, these are double the timetable, meaning they have to make money twice as fast as a regular option because you're long 2 options. So you've got twice as much time decay factored in. So if you see a quick move early, don't expect to hold this all the way till expiration. Take the money off the table, take the profit, and live to fight another day. So as always, I hope you guys really enjoyed this video talking about market neutral strategies. As always, if you like this video, please share it right below here with any of your friends, family, or colleagues on any social network.